Rishi Anand, the MD and CEO at Aadhar Housing Finance, joining in on the show right now. Rishi, hi, morning. Good to have you on the show. Let's try and understand and get your sense on the overall liquidity in the system right now. Is there any issue in banks and NBFC as a sector as a whole?
Okay, so from a entire industry perspective, when it comes to housing finance companies, I don't think there are any failures from any of the sources. So, for example, a housing finance company typically would borrow from multiple sources, and whether it is banks, whether it is the NCD market, whether it is NHB refinance mechanism, I have hardly heard from industry that anybody is facing any liquidity issues.
Okay, let's also understand then from you as to what exactly the outlook is when it comes to the start of the festival season, because we've not really seen any special offers from NBFCs for loans, especially home loans or from banks. What exactly is holding you guys back, you think, from festival offers? Could it be the right time or any game plan on that front?
Generally, these offers will typically come during the Diwali Dashera time. I think we should just wait it out. Ganpati time, generally Ganpati is more focused on certain states. So the Ganpati festivals, I don't see too many people, and historically also not too many companies come out with larger schemes. Schemes we generally float around Diwali Dashera, and we should just wait out. The demand side is quite robust. I'm sure a lot of schemes, especially from LMI companies and premium housing finance companies, are going to be coming out. In the affordable segment that I cater to, or companies like us cater to, we have historically not done too many schemes, and we don't intend to look at too many schemes even in the festive season that is coming ahead.
Right, and everyone's expecting a rate cut by the Fed. So will banks wait for Diwali or Dashera, or are they going to front load it and might cut before that?
See, I will not say it is fair to relate with the rate cut, because irrespective of the rate cut, if there is a festive scheme, festive season, festive schemes will definitely come. As far as rate cut is concerned, I think the entire industry is expecting the rate cuts to start happening towards the second half of the current financial year. And as and when the rate cut happens, the rate cut directly impacts the consumer who is already on the books. Not necessarily only incremental consumers, but even the consumers on the book. So if a rate cut happens and the banks are able to pass on the rate cut to people like us, we will immediately pass it on the consumer. So I don't think these schemes or the rate cut are interrelated at all.
Fair enough. So how is the rate cut going to impact your borrowing, your net interest margins, and your overall business growth?
No, so the working is very, very simple. I borrow, and if I can explain it here, I borrow from a bank. I put in a certain spread and I lend it to the consumer. And if either ways, it works, the bank either cuts rates or increases rate, the spread is still maintained and the differential is passed on to the consumer. So in case of a housing finance company or any other company for that matter, if the NIMs if the spreads are protected, the NIMs are protected. So financially, there is no impact to the company. And to top it up, when we talk about Aadhar housing finance, 80% of my consumers are on floating rate and 80% of my liability is on floating. So whatever comes in is passed on to the consumer, either ways, either it's a hike or a drop.
Right. So currently about 52% of your borrowings are from banks, although it's down from 62%, which it used to be in FY21. Why is this shift in borrowing? And have we been hearing, we have been hearing rather that banks are reducing their funding to NBFCs after risk weight increase. Are banks lending less to NBFCs? And what kind of a shift are we going to see in borrowing profile going forward?
So I don't think there is any specific reason why there is a drop in exposures from the banks. I think it is our own strategy to diversify more in terms of liability profile. Exposing yourself into one particular source is always risky. And deliberately, we have taken all actions towards that. For example, if the years that you're talking about, our NHB exposure was almost negligible. And today our NHB exposure on refinance stands about 25%. Our NCDs stand at about 25%, and the balance is the banking. We have also in the current financial year added another borrowing profile, which is DFIs. So we have a lending line from IFC and ADB. And as we go ahead, I think these four components will continue. We might want to look at ECBs if we get a rating upgrade from a double A today that we are rated to a double A plus. We might want to look at profiles like insurance companies where you PFRDA insurance companies where you tend to get long-term funds.
Okay, and from FY20 to 25, there's been a 32% increase in the average ticket size from 20.1 lakhs to 26.5 lakhs. And even for Aadhar housing, the average ticket size has increased by about 10%. What will you attribute this to?
See, I think it is a right observation that you have made with respect to increase in ticket size, and primarily I would attribute that to two things. One is inflation, of course. Every year, inflationary cost takes up the cost of construction, and more importantly, the cost of construction itself. Cost of construction 5 years back, for example, was close to in the LMI segment was close to about 2,000 rupees a square foot, and that we are looking at that cost going up substantially to about 3,700 rupees a square foot. So cost of construction is the main component because of which you see an increase in the ticket size. For example, illustratively, in our segment, if a consumer about 5 years back were to construct a two-bedroom house, it would suffice a loan of about 8 lakh rupees. And the same consumer with a two-bedroom house today wants about 12-13 lakh rupees. So that inflationary increase in the average ticket size and the cost of construction has actually pushed average ticket size on both the segments, on the LMI segment, which is lower middle income group, and the affordable segment. I don't think there is any deliberate attempt by any housing finance company to increase the ticket size. It is more to do with the market trends.
Right. So in the HFC sector, is there any shift from affordable to prime segment?
I think there is obviously in the last a decade, if I were to look at some broad data numbers, there is a definite shift in terms of and it is primarily again to do with the cost. The average ticket size rising. 5 years back, my average ticket size, as you rightly said, was about 8.5 lakh rupees, 9 lakh rupees. Today, that incremental average ticket size has moved to about 11.4 lakh rupees. It is again to do with the cost of construction and the end user market value of the property.
And how will the company benefit from PMAY 2.0, the construction of 3 crore houses? What is the plan over the next 3 to 5 years?
Okay, so I think I will take a little more time on explaining you this scheme, because this scheme apparently looks like completely misunderstood in the industry. One is, when we talk about the broader umbrella, which is housing for all, in that you have multiple verticals. One of it is construction of houses, which 3 crore houses, as you rightly said, have been announced, out of which 2 crore houses are going to come on the urban poor. More importantly, another big vertical of this housing for all scheme is the credit linked subsidy scheme, which in the earlier avatar credit CLSS 1.0, which got over in March 22, has been re-announced starting any day. The final contours are yet to be out, but broadly, as we understand, that 1.8 lakh of subsidy is going to be granted to consumers over a period of 5 years, which effectively means 36,000 rupees per year is the kind of subsidy that will be given to the consumers. The first cut, terms and conditions mention the word on tap, which looks like it might be a direct credit to the consumer. If at all it happens, it will be good for the entire industry. There was a huge industry demand on giving it directly to the consumer. Plus, more importantly, this scheme will help companies like us, housing finance companies like us, because if the consumer were to avail this subsidy for 5 years, he will have to be non-delinquent for 5 years. So this should effectively help reducing the delinquency trends. Secondly, there is in our industry there's something called or a buzzword called BT out, balance transfer out from one company to the other. Now, if a consumer is registered through, let's say, Aadhar Housing Finance, and he wants a subsidy for 5 years, effectively he should be, staying with Aadhar Housing Finance for 5 years. While I don't think there will be any such condition, but moving out of Aadhar and going and registering himself with any other housing finance company would be a tedious process. So effectively, delinquency should get affected positively, and BT out should get affected positively.
Right. Okay. Great to have you then, Rishi, on the show. Thank you so much for joining in and speaking with us today.
If you like this video, then like, share and subscribe to ET Now.